Let's bring it back to the technicals back home. Sushil Kedia of CIMB has joined in with his view. Sushil, morning. First, the global setup. Do you think something has changed with the S&P just falling short of its all-time high, or do you expect the global momentum to continue?
Udayan, things have changed there, though not necessarily because it just missed the all-time high. In fact, the internals of the S&P 500, except for the telecom sector there, all other sectors have had already gone to an all-time high. And applying a little contrarian thinking to this one thing, how many times do you notice that all sectors in a market, and particularly the largest market in the world, are all up together into a new high? Such a kind of ebullient situation does not last for long. Change is the only constant in markets, and if the polarization has come to this level, the opportunity is to really wait for a confirmed down move, and that might have just begun in terms of this large gap down that it will open at, and there are certain other patterns along with which it is coming. The momentum has been very divergent in S&P for a good time, and last 2-3 weeks I've been constantly talking about waiting for a confirmed sell signal that might have already just come in. One will get much more confirmed once I notice a closing below 1516, and the odds are more than 90-95% for a top to having been placed there right now.
Sushil, morning. What kind of signals do you see on some of the European indices as also in Asia on the Hang Seng, etc.? Because over there reactions have been quite stark.
See, Hang Seng has been in a downtrend, an intermediate downtrend for almost 2 months now, particularly the Hang Seng Chinese Enterprises Index, which is much more relevant for our goals in terms of tracking the Chinese market. Yet, the European indices, they have been very similar to the S&P 500, mimicking one very good pattern, which is prices continue to make newer highs, whereas momentum, in my case I measure it with RSI, you can apply any other tool, whereas momentum refuses to make higher highs. It's very similar to your car keeping on moving forward, but the acceleratometer is not showing the needle going towards the right. So loss of momentum while prices are dragging further upwards, and now with these large down gap reversals, in many markets it will turn out to be reversal gap down. So I would place odds at more than 90% for today to be a top in the Western world. If it eludes us again, I still am not going to be looking for buy.
How does this all translate into what you see happening on the Nifty then?
Nifty placed its top a little ahead of these Western markets and slightly after the Korean market. The 6100 level for now is the top, and yet, Mitali, in my prior interaction with you about 2 weeks ago, where I talked about 5600 and then some rebound, and then eventually maybe 56 also breaks and goes down to 5200. I would like to reserve a bit of this forecast that I discussed earlier with you, that okay, we did go to the 5600 plus range, and the rebound from there on has been much stronger. It did not get arrested within 5850, 5900. So one should keep now a room open for a sideways correction potential to be greater than a slide down to 5200. For now we are again going down to the lower end of the trading band with today's down gap open and any mild intraday rebounds. But yes, once we get closer to that 5600 area, that's when greater clarity will come if again a reversal is coming and we will again go back to 5950. And it could very well happen that next month and a half, we might oscillate in this range. That's, I would say, about 60% chance, and I'll still keep a 30% chance for a breakdown to 5200.
But just in the near term, what is a higher probability outcome? A retest of 6100, which looked possible just a couple of days back when the Nifty went to 5950 plus, or a retest of 5650?
No, then this is indeed a tricky patch of the market, and any forecast, at least from me, is more of an educated guesswork. With that caveat, I would still tilt my hat to an idea that we are less likely to go to 5970, forget 6100 for now, and more likely to go towards 5600. And why I say so, any technical indicators, whether moving average crossovers, your MACDs, your even RSI crossovers, on weekly time frames and daily time frames are divergent right now. The market is doing something else in the weekly time frame and doing completely opposite in the daily time frame. So it's more like a phase of adjustment. A humbler call is to say, think about a trading range behavior. Though, looking at the larger structures of Nifty and elsewhere in the globe, one still keeps for the medium term still a 30% chance for 5200.
What does
and within which, the bank index, which is the higher beta sector, in the latest fall on the Cobra post day, Nifty only mildly broke under 5800, but CNX Bank went all the day down to the budget day price range. The autos are very weak, so except for a strong rebound up in metals and infrastructure, which too again are looking like rally patterns, the key drivers of the market, banks, autos, they are clearly looking very weak. So the odds remain on clearly for within this range to go to 5600 first.
What does it all mean for the rupee, which had a scare above 55 but then went back to the 54 kind of levels again?
See, rupee in the very short run can be a little noisy like this, but say if you take a 1-2 months kind of a view, and I'll also like to talk about my next 3-4 years view. I think on a longer term, 3-4 years kind of a move, Nifty is the rupee is currently in the last leg of its weakening cycle. This weakening may go as much as 59, perhaps it might taper off at 57, and that might all happen over the next 3 to 6 months. But for the shorter run of a month and a half, I would say 54.1 is what should be kind of an extreme stop loss for any rupee strengthening view, and the trade to play for is a weakening of the rupee going up to 57 or 59.
You mentioned the banks, Sushil. Any other specific pocket that looks very vulnerable or likely to lead the market lower?
See, CNX IT, which had been playing the real strong sector, and even after the budget meltdown, it really continued to make into a newer high. Led by Infosys, CNX IT has, to my mind, now placed a firm trading top, and that is what is going to be dragging Nifty in the next 4 or 5 days. And this might very well turn out to be the top of the year for CNX IT, perhaps, despite the fact that rupee can continue to weaken. And that fundamental assumption about a strategic percentage allocation CFOs of all IT companies do, and they are mechanically trading, has not been proven right. If you run correlations in the past, there's a greater explanation of the individual stock behavior explained by Nifty. There's a far stronger beta with the Nifty than with the INR. So I think that is one sector which is going to create a lot of negative surprise for people, because most of the time the common thinking is a weak rupee means stronger IT stocks. It never has worked except for a week or 10 days. And the metals and the infrastructure stocks that have just made a sort of rally, I think metals will go and make a newer low than they made around the budget time. Banks, for now, they have buoyed up a bit, and there is a deep risk downside on them. So banks, metals, infrastructure, metals, almost everything. Vitali, let me answer it this way. Do I see a sector which can prop up the Nifty and keep it buoyed up and can create an upward pressure? Answer is no.
Thanks, Sushil, for joining.